Rahul Singh, CIO of Tata Mutual Fund, is joining us to take the discussion on market forward. Rahul, afternoon. Rahul, there are just two things which market appears to be pretty nervous about. One, global rising yields, mainly US, and higher for longer narrative now. And the other is the rise of dollar index. How much vulnerable are Indian equities to these two issues, and how do you see the end of this? What are these two things or indicators rallying on?
Yes, you're right. I think the major issue seems to be more global at this point of time, that the higher for longer interest rates are beginning to have impact on the valuations, even though India seems to be doing better both from a macro and micro perspective in terms of fundamentals. Beyond a point, I think the valuations would start to get impacted. Having said that, I think it could be again a case of a little bit of a time correction rather than a sharp correction, downward correction in my view. Because as I mentioned, in terms of fundamentals, whether you look at growth, we growing faster than China and other emerging markets, or in terms of the health of the corporate balance sheets and the bank balance sheets, I think we are standing out. So to that extent, our premium valuation to other emerging markets will continue. But yes, on an absolute basis, the factors which you mentioned are beginning to have more and more of an impact. And what this will do is, as a result, is to prolong this period when the market could move just sideways before we become slightly more reasonable in terms of absolute valuations. But I don't see, still I don't see any reason to have very sharp corrections at this stage. I think it's a question of just absorbing and digesting the move which we have just had in the last 3 to 6 months.
Mm-hmm. Rahul, when you are looking at the market performance of say top 15, 20 markets including India, we saw that many markets have corrected quite a lot from their recent tops, but India has not corrected a whole lot, just 3 to 5% on the benchmarks, and mid caps have rebounded very sharply. Does this make us vulnerable in terms of flows if indeed there's a much more pronounced risk off globally because of rising yields and dollar index? Are Indian markets also, because there is so much to be taken off the table, so are we vulnerable, and should we be cautious at saving some dry powder at this point in time hence?
Yeah, I think if it's a pronounced risk off based on some financial dislocation which might happen as a result of higher interest rates. So look, higher interest rates, if they go up gradually, resulting in slight downward pressure on valuations, I think is par for the course. We should be prepared for that. But what could happen as a result of these high bond yields, especially in the US now that the yields have moved up closer to 4.7%, the 10-year yield, is that can it trigger some kind of financial dislocation in the markets, and can there be some financial accidents waiting to happen? We saw that happening in the case of the bank collapses which happened in the US. Can there be more such events? I think we need to be watchful of that. Difficult to predict which way, whether it will happen or not happen. But yes, those are the kind of events which can lead to pronounced risk off, which could have a slightly bigger impact on the Indian markets also than what a more par for the course gradual movement of yields is likely to have.
Right. Rahul, how should the portfolio be positioned in such a kind of a scenario? Which are the undervalued parts of the market in your view, which one should have a slightly overweight stance on should a correction or corrective phase of this sort arise?
So I think in this kind of a scenario, two things become important. One, obviously, asset allocation at the investor level, having the right amount of debt and equity or hybrid products, which is suitable to your risk appetite and your needs. I think that's the first level of risk management, because this is a market to manage your risks, not to be out of equities completely. And how do you manage the risk is through number one, asset allocation, the right asset allocation for you, and number two, when it comes to managing the equity portfolio, which is what our job is, to have balanced portfolio, play the domestic cyclical recovery, play the domestic capex cycle recovery, but at the same time be cognizant of some of the global risks and some of the risks arising out of the risk off, like you mentioned. So a balanced portfolio between large cap, mid cap, small cap, between sectors, between domestic cyclicals and global cyclicals at the right price, I think become extremely important. The good thing about Indian markets is that we've got huge, huge variety in terms of the width of the market. We have at the one end banks and IT services companies, which are obviously the highest weightages in the index, but on the other hand, you have sectors which are doing well, like manufacturing, capital goods, industrial, cyclicals, where the representation is more in mid and small caps. And then you have sectors, defensive sectors, specifically pharma or FMCG, where which you can use to balance the portfolio. So I think this is a time to have a more balanced approach even at the portfolio level rather than just at the asset allocation level.
Just before I let you go, Rahul, I want to understand your positioning as a fund house regarding two global centric sectors. One is pharma, which saw very big, huge kind of a basket buying in Friday's session. Almost every stock was gaining, including India centric names. And the other is IT, where the jury is still out whether the worst is in the price on deal visibility or not yet. What are your thoughts on these two global centric sectors?
Yes, I think in pharma, we seem to be coming towards the end of a multi-year down cycle in terms of the way the generic pricing or the US generic market has behaved. So there is a huge, cyclical factor at work, and I think barring these 6 months of COVID when pharma sector did well, by and large for the last 6-7 years, the sector has been in a down cycle, at least the export part of the market or the non-domestic part of the market. So that I think is an exciting thing to happen for the sector, that we are nearing, or as far as the data points are concerned, all data points indicate that we are towards the end of that down cycle, and we could have slightly more stable pricing environment in the US, and that could itself lead to some bounce back in growth. So that's an opportunity for pharma sector. As far as IT is concerned, I think you're right that there are things which are still evolving in terms of how the global environment or demand environment for these companies will pan out. Having said that, there is no panic which was there in March when it looked like there could be significant revenue declines and deal flow slowing down. At least as things stand today, deal flow continues to be strong. Yes, it is not the usual transformational kind of spending, but more cost takeout, large deals where lesser number of companies will tend to gain. But the deal flow continues to be quite strong. As far as the revenue growth is concerned, it will probably take 12 months for the revenue growth to bounce back, because most of the deal wins which you get will start reflecting in revenue growth only in fiscal 25. So there is a bit of a waiting game there going on for IT services, and valuations, although they corrected in between, I think they are now at a fair to slightly higher range. So we just still need to absorb some of these news flow and for the valuations to kind of become slightly more palatable before we get very aggressive on the sector.
All right, Rahul, we'll let you go on that one. Thanks so much for joining us on the show today.